So I recently had a client reach out to me with a question that I thought illustrated a very important point. This was a solo doctor in a GP practice looking to hire his first associate. And he asked me the question. He said, "Chris, if my current overhead is 65% and I have a profit margin of 35%, how can I afford to hire a doctor and pay them 30 or 35%? And this illustrated the important point that our brain can play tricks on us. Okay, I'm actually going to just read exactly our text message exchange. So your current overhead of 65% is based on your personal dental collections and is a mixture of fixed expenses like rent and team cost, as well as variable expenses like labs and dental supplies. The vast majority of your overhead is fixed expenses, and the vast majority of the fixed expenses is team expense, either hourly or salary employees. This amount only goes up if you add another dental assistant for that new doctor. When you add a provider, a doctor or hygienist, the only added expense is variable labs and supplies which track with the amount of dentistry being delivered. These should be a combined maximum of 15% of the new dental collections generated. Add 35% in for doctor pay, and the profit on the new doctor collections is 50%. Adding this new profit to your existing business revenues and expenses drives the overall overhead percentages down, which is the definition of scaling your business, getting more profit out of fixed overhead. Your overall overhead of 65% will begin to go down as the doctor becomes a larger producer. Here's an example. Let's say that you have an associate who does an annual collections of $800,000. Let's say that you had to hire 2 new dental assistants for that doctor at a total of $80,000 a year salary. Let's say that 15% went to lab and supplies. 15% of $800,000 is $120,000. And let's say you had to pay the doctor 35% of collections, so the doctor got paid $280,000 out of the $800,000. $800,000 minus $80,000 for the dental assistants, minus $120,000 for lab and supplies, minus $280,000 for the new doctor pay, still leaves you with $320,000 of new profit, which is 40% of the $800,000 in new collections generated by that doctor. This new net $320,000 profit added to your current business profit drives overall overhead percentage down. You see, providers, both doctors and hygienists, are revenue drivers. They are not new overhead.